Welcome to Core Finance, where I'm joined by Alejandro Zambrano, as Chief Market Analyst at Amana Capital. How are you today, Alejandro?
Very good, sir, and you?
I'm delighted. I'm happy that the currency markets are finally moving. In fact, they're moving so much. It reminds me of my youth in the 1990s.
1990s,
I was still bald then, but it's my youth officially. And so that's when things were moving properly, when there was like there was central bank intervention in the market, and that made things move around. But now we've got, what's the reason now? Central banks trying to talk things higher or lower?
I think, the classic model has been, by the currency of the country where they're looking to raise interest rates, and that model, has been broken down a little bit, at least recently, I think.
So that model will probably catching people out in a way is what's causing the volatility now.
No, I don't necessarily think that's really what's causing the volatility. To be honest, I think it's quite hard. It's hard to explain really. Maybe from a positioning perspective, we can explain things. Maybe people have been betting too much on the dollar, and at the same time, we see them pulling back from the expectations from the idea of raising interest rates. If you look into inflation, it's most likely going to continue to moderate. So it's likely really that that the Fed maybe delays interest rates even more. But I think the core issue here is that a lot of people were positioned against the euro, as an example, against the Australian dollar, and now they don't see the reasons really to keep holding these positions. And as well, we've been in a technical sideways market conditions, right, for the euro dollar, like 1.5 years. And I noticed in the last week or so, every time I'm trying to get involved, like buying euros on dips or the Australian dollar on dips, you have like 25 pip retracements or so. So it's interesting to see how the dynamics is changing, because we have a different volatility regime potentially emerging, which means pullbacks are less severe and the market just continues to go higher and higher.
Which isn't nice if you're trying to either get in or you're on the wrong side of the equation. So you probably let things go against you rather more than you should as well.
I think what is happening here is that, like 2-3 weeks ago, if you would have like a move in the euro dollar, then I would easily just take the Fibonacci from the low to the high, and then anticipate a 50% pullback of the last, say, 2 to 3 days rally, and you would eventually get an entry maybe 1 or 2 days later. So I think what's going to happen now is, if the trends continue to be strong, instead of looking for say a 50% pullback, you just pull back to the first Fibonacci level, maybe looking to go long there. A different strategy as well, which could work, is that you start to go for breakouts again. So for example, if you look at the euro dollar, it reaches a high, trades sideways, and then breaks above the prior day's high as the London session start. This was extremely easy, I remember, in 2013, 14, 15, to work with such ideas. And then when we start to trade sideways, that will be a pure losing strategy. But in the last 2 weeks, suddenly
started working again. Well, I hope people are watching and taking note of that one. Let's have a look at the charts that you brought in. First, euro dollar, where I was told with quite a lot of confidence it wouldn't break 109, then 110, 111, 113. 113 especially, it was not supposed to break at all.
Yeah.
And it broke that, and it actually never tested it as support, I think, when it was that fast. The train left the station rather quickly.
Yeah, definitely. So we'll see what happens now. So we obviously had the ECB rate meeting. So for now, this is a monthly chart, right? So for now, maybe it's the final push to get everyone short stopped out, and we might have a reversal. However, though, if we don't have a reversal, then it could become really interesting, because, again, we've been consolidating since 2015 here. And if we continue to move up higher, we might reach levels like 120, and then the other level I think is 126.50 or so. We need to remember, especially when the markets have been consolidating for some time, the trends tend to be quite volatile. Now this is a monthly. To actually execute a position on this, we don't use the monthly. You can use maybe a 4-hour or a daily chart to kind of pinpoint which lows are important. And then either you try to go for that pullback or the breakout, but the pullback is really my preferred method.
Okay, let's go on to the Aussie dollar, which I think you called it correctly, I suppose, on the way down a little while back, but we've now had the breakout, and
Yeah.
it's again one of those things that just took the level out and never looked back, which is unusual.
It's unusual, and I mean, it's interesting because heading into this event, there was a lot of, you had the Chinese PMI, it went below 50, so there was more reasons to be bearish on the Australian dollar, and at the same time you had a big collapse again in iron ore prices. So it's interesting because the macro fundamentals maybe don't necessarily warrant such a move, but the fact that we're having a technical breakouts in the euro, in the Aussie dollar, and shortly we'll show you the New Zealand dollar, makes sense to at least go with this for some time. Because again, the market's been trading sideways here, and now we have a break above 77, 73, with the next natural resistance level being 81.64. But I think we could potentially go all the way up to 86.42. But again, the macro fundamentals don't necessarily suggest that this is necessarily the best strategy. What's a good example? Well, all the data from the US has been terrible, and if you look at the Citigroup Economics Price Index, it's on rock bottom. So if anything, the US data is probably going to improve. But again, the market is worried maybe about Trump or other things, so just the positioning here. So for now, again, don't trade on using the monthly chart, but maybe a daily or 4-hour, and then just try to ride this for as long as possible.
Okay, and then just finally, we're running out of time, but just echoing what we're seeing at the Australian, but obviously, let's say it's probably a little bit behind, in fact, isn't it?
It's a little bit behind.
Broken out.
Yeah, I agree. It hasn't really broken out, and here I think as well the potential gains are less, because we're trading at 74.27 or so when I took the snapshot this morning. And the next resistance level is 77.54, followed by 79.29. So here there's limited upside, unless of course we see major changes to the Australian economy. But the inflation readings was lower this week, and I don't think the central bank wants to raise interest rates anytime soon. But again, I think it's positioning. Maybe the fact that it's summer, there's less liquidity. You can definitely notice a difference in the way traders behave and the markets behave in the last 2-3 weeks.
Okay, we'll see how it goes. Alejandro Zambrano, Chief Market Analyst at Amana Capital. Thanks for coming in today.
Thanks so much for having me.